Good afternoon. It is Wednesday, October 14th, 2020. My name is Sarah Maley, and I'm joined today by Charlie Coleman. Today, we're going to discuss just some of the dispersion that we're seeing from a sector's perspective, as well as within factors looking at just some of the major factors from a large cap perspective. And from a sector perspective, I mean, through yesterday's close, Charlie, we're seeing tremendous dispersion. I mean, between the best performing sector so far this year, technology, and the worst performing, energy, we're seeing about an 83% performance dispersion there between the two.
Yeah, that's pretty amazing, because going back even past the great financial crisis, we've really never seen dispersion blow out this wide. If I remember correctly, the widest dispersion we had seen was back in the 2008, 2009 period, and it was roughly 50% then. So now currently we're seeing much higher levels of dispersion. But it's really not surprising when you look at the sectors and you start looking at those underlying companies within them. When, after the crash we saw back in March, it's really been those technology companies that have benefited the most, especially the mega cap names, think your FANGs. While energy names have been hit particularly hard with not only oil prices that have continued to crash, but problems within natural gas and other areas of the market. It's just really amazing how wide that dispersion is, and how it just continues to grow. And really that dispersion, for this year is really just a snapshot looking back over the last roughly 15 years. We see that technology and energy have continued to have a wide dispersion. Technology has been the best overall performer over the last 15 years post-crisis. Look at the Qs, and I don't think anybody would be surprised with that. While energy just really has fallen out of bed pretty much year after year. Since 2014, it's actually been the worst performer, all except for 1 year. And that's just something we haven't seen in a while, since really looking at real estate leading up to the crisis.
Yeah, and just to put the current performance dispersion number into perspective, on average over the last 16 years, we've seen the average dispersion, between the best and the worst performing sector come around 38%. So that 83%, well above that average. We still have one final quarter to go of the year. So we'll see if, the momentum here can, keep these two sectors and, the leader and the laggard. And we've seen that the dispersion between these two really carry over into momentum strategies.
Yeah, and primarily that is because momentum strategies are really designed to overweight strong areas of the market. Currently, think technology, consumer services, consumer discretionary. Those really are the areas of the market that have been doing very well. And as you can see at the top of the chart, PDP, which is momentum, and growth for that matter, are both doing extremely well this year. They're up over 25%. While I think this was pretty surprising to me when I looked at it, dividends, SPYD, S&P 500 high dividends, is absolutely at the bottom, down 27% for the year. But really looking post-crash back in March, not surprising when you see a lot of these companies start cutting their dividends, and shareholders, have really shown that they don't appreciate when a stock cuts their dividends. They really penalize them for that.
And we were talking earlier, Charlie, I think you mentioned that SPYD, that high dividend ETF, actually has about a 10% weight in energy, which has really caused that fund to lag.
Yeah, definitely that's part of it. The other part, really looking at that, is it's got roughly a 24% position in financials, which, it has not necessarily been as bad of a sector as energy, but, it is still negative for the year, still having some issues within that sector, with really everything going on that's in the markets right now.
Yeah, and earlier this year, we touched on the high dispersion between just growth and value itself, looking to still be about around 30%, which again has benefited momentum strategies such as PDP, really focusing on those high growth technology names that we've seen really drive the major market indices so far this year.
Yeah, and actually, in this year's case, it's almost as important to own the really good stuff as it is to not own the bad stuff. Really, this year, by just taking out energy, by reducing that exposure to financials and real estate and some of those other areas of the market that have been really lagging, you could almost own the rest of the market and do exceptionally well compared to just owning, say the S&P 500.
Yeah, I think really, we're still seeing that dispersion between the S&P 500 and cap weight and the equal weight. I mean, there still is about a 10% performance dispersion there too, telling us that, it's really those large cap names versus those small and mid that are really driving performance. So when we see dispersion between those two, that's kind of what that's telling us.
Yeah, and that's really evident when you look at something like the Russell 2000, which is composed of small cap names. It's basically flat for the year. It's down just under 1%. But really, when you hone in, you look at a security like DWAS, which is small cap momentum. That one's up over 15% for the year. So those leaders in those strong sectors really are doing a fantastic job at really pushing the market forward within those specific areas, but you're really getting that drag factor from parts of the market that necessarily aren't working as well.
Yeah, so I think here kind of the takeaway is just knowing what you own. It's very important these days to really focus in, again, like you said, on not only what you own but what you don't own, because it is those laggard areas that really could drag you down, like we said, energy down almost 50% year to date, along with financials down a little less than 20%. And again, going back to that, technology up 33%. So really just, again, making sure that you are in those areas of strength, and momentum strategies can most definitely help you do that.
Yeah, that's exactly right. And the other part is on the factor side is really looking at your factors and knowing when you want to own a factor and when you don't, or why you own it. Sometimes pairing factors, that works very well over time, but you have to understand that during dislocated periods like right now, not all factors are going to be created equal, and you need to be prepared for that in your portfolio or in your client's portfolio.
And I think, just looking at our lineup of models, we really do provide a lineup of models where the rules-based, set it and forget it type of thing. And it really will take the emotion and the guessing work out of, those leading areas, especially from a sector perspective. So like the First Trust Focus 5 model, instead of hand-picking those sectors yourself, just kind of let the model do the work for you.
Yeah, that's exactly right. And, following one of our pre-built models or really using one of the tools on our site to go through and create your own rotational model, whether it be factors, sectors. We've seen also the same thing within countries, and hopefully we'll touch on that in the next couple of weeks as well. Really going through and having that disciplined style within your portfolio management, really has been shown that to add additional value over time.
Yes, if you have any questions on any of the things that we've discussed today, or any of the funds or models, or just any of the, walking through our site, you can actually create this custom performance quote yourself through the performance tool. So if you have any questions on any of that, please feel free to call our analyst team, 804-320-8511, or you can shoot us an email at dwa@dorseyright.com. But other than that, Charlie, thank you for joining me today, and we will see you next week.